Welcome back all. This is volume 3 of the Volatility Master Settings series. We don't have very many settings to get through now, so they'll all be covered in this video. There will be, I guess depending on when you watch this, they already may be out, but there will be more volumes coming because I do have some improvements and upgrades to the software coming, as I always do. So as they come out, I'll add videos to these volumes, so that you know what the new settings and upgrades are and how they work. But let's share my screen and we'll get into the rest of these ones. So we were up to the mitigation setting. And I'm just going to quickly talk about the next two settings first. Use limit orders for stacked and use limit orders for initial. So that's for the initial trade and for the stacked trade. So you can either choose to use normal trade orders or you can use limit orders. So that the difference being is that if we're using, if like we're talking about the initial trade for now, sorry, this one here, use limit orders for initial, we have it set to false, so we're not using limit orders. So what it's going to do is when the market breaks above this red line, it's going to place a buy order right there. If we are using limit orders, so if we have this set to true, then when the market breaks above and gets to here, it's not going to place a trade there. It's going to place a limit order further down. And in this case, it's going to be 5 points below the red line. So we'll just put it here. And so a limit order isn't an actual active order. It still requires the market to retrace to hit it, to activate it. And then you end up with a normal order right here. And so the idea behind this is that you get a better entry position, you know, because it's a buy order. The lower it is, the better the entry point. And the stop loss is still going to go where it always goes, which is just below the blue line. But because the entry point's lower, it means the stop loss is tighter. So we end up with a better entry point, a tighter stop loss, and therefore potentially more profit. So that's the idea behind the limit orders. And the mitigation setting simply determines how far back the limit order or how far down the limit order is going to get placed. So let me just show you that working on the chart. Back test is always slow when I'm recording. Let's just fast forward here a bit. And what we're going to be looking for is when the market breaks above the red line, let's have a look at where it places the stop loss. I mean the take up, where it places the trade in the stop loss. Okay, so it's broken above and right where the market was, it's placed that buy order. It's placed the stop loss down here. And I'll just measure the distance between the trade and the stop loss. It is 756 points. All right, so that's how it works when we aren't using limit orders. Just remember where this trade was just a little bit above the red line. Now, we are going to come down here and I'll change the use limit orders for initial trade to true. So now it's going to be using the initial trade. And I'm also going to change the mitigation setting to 30. It's not what I generally use, but it'll make it more visual on the chart so we can see what it's doing. So this time we'll back test that same little place and we'll have a look at the difference. Okay, so We're going to watch what happens when the market breaks above. That setting's still the same. It's just going to place the trade in a different place this time. So it broke below, and now it put the trade right here, and it required the market to retrace a little bit before it activated it. So now if I pause it and we have a look at the distance between the trade and the stop loss, last time it was 756. This time it's only 680. So, the stop loss is a lot closer, which means your risk to rewards can be better and all of that. But what I wanted to show here, though, was just want to make it a little bit more visual. Now, from the red line down to here is 231 points. So let's just radically change the mitigation setting. We'll change it to 200. And we'll just do that little back test again. So this time it's going to place the limit order as soon as the market breaks above the red again. But this time it should place the trade right down here somewhere. There you go. So it broke above and it placed a limit order here. So now it requires the market. It requires the market to retrace all the way back to here to activate this trade. But then, we've got a much, much better entry position, which means, that tighter stop loss, much more potential profit. The drawback here is that if the market doesn't retrace all the way back to here, then we won't get the trade at all. So, the further back you can place a trade, the better potential profit. But the drawback is if you place it too far away, the market doesn't retrace and you just don't get the trade at all. We'll see here it's a limit order and it just got hit, so now it is a buy order. And what I also want to show you is that the trade size is 5.38 lots. But I didn't show you before, but because we've mitigated that far, meaning the stop loss is a lot closer, the software, and because we're using the automated lot size calculation, it was able to make a larger trade size. A larger trade size than, remember the trade size was 5.38. If we turn off the limit orders, so now it's going to place the trade right up here, we'll find that the software places a much smaller size trade. It'll still be risking the same percentage, but the trade had to be smaller because the stop loss is further away. Now let's just go through just quickly so we can see what size trade this takes out. So it's a 3.96 size trade. So because the trade's placed a lot further away from the stop loss, it had to make a smaller size trade so that we were still risking the same amount of dollars. So keeping that in mind, you can see why mitigating and placing the trade here is potentially gives you much greater potential for profit simply because you're getting a larger trade size. We're still only risking the same amount because the stop loss is closer, but we have a much larger size trade, meaning that we're going to be making a lot more money as the market moves up. All right, so that's sort of all the advantages and disadvantages of using limit orders. And if we get back into the settings, you can see you can set limit orders up for the initial trade, and the other option is for the stack trade. Stack trades are any trades more than just one that are open at any one time. So the first trade it opens at any given time will be an initial trade. Any of the extras that it stacks in will be stacked trades. And so I can't actually remember if I covered this in a previous video, but the beauty behind stacking trades and doing it the way Volatility Master does is it will never ever place a second trade unless the first trade is in a risk-free scenario, meaning that the profit lock's activated and the stop loss is being placed above the entry point, meaning that even if you hit the stop loss, it will give you a profit. So once that trade's in that situation, then it can look for another breakout and set up, and it will place a second buy order. But because the first order is risk-free, we still don't have any more at risk than we have set. So in this case, I've got the risk percentage set at 3%. So when it takes out the first trade, I have 3% of my account at risk, meaning that if I hit the stop loss, I'm going to lose 3% of my account balance. But then if the market moves up and the profit lock activates, making it risk-free, then it can look to open up a second trade. And when it opens up the second trade, even though we have twice as many trades, we still only have 3% or a little bit less of my account balance at risk. So we have stacked extra trades, meaning we've doubled the potential for profit, but without ever increasing our risk. And it'll do the same with the third trade. If the first two are risk-free, it can do a third trade. But at that stage, it's only that last trade that could possibly take a loss, which could potentially be a 3% loss. So the risk hasn't increased. We now would then have 3 trades open, but the first 2 are going to make profit, and the third one could still potentially lose. So we can stack trades without ever increasing risk. And that is probably the number one. Well, it's definitely one of the very best features of this software, which you simply won't see in, well, I haven't seen it in any other software that possibly are, but I haven't seen that. Alrighty, so that should cover mitigation and the stacked and initial trade limit order settings. The bottom setting, ADR days, 20. That's simply you telling the software how many days it wants to use to calculate the average daily range. So that's calculating the average daily range of the last 20 days to be that, and the highest daily range for 20 days is that. So that, as I said, doesn't play any part in the way the software trades. That's simply a visual display for the user to look at. And that just simply leaves the range period initial and range period stacked. Now, this is a new feature. As of this video, it's a new feature anyway. So previously, you just had one setting called range period, and you could set that at any time frame you liked, and that would be calculating the top and bottom of the range based off whatever time frame you choose. So in this case, it's going to be a 5-minute range that it's calculating. And that's what it did for initial trades and for stack trades. But what you can do now is you can set a different range period for the initial trade, and then a different range period for the stack trades. So what I find is quite beneficial is that you use a higher time frame for the initial trade, meaning you're getting a more definite breakout because you're looking at a higher time frame. But then once you've got that direction started, then you can stack the trades based off the 1 minute. If you try to stack trades based off too high of a time frame, you simply won't get enough opportunities to stack trades. So I still generally use the 1 minute. You could use a 5 minute, I guess. But this is sort of what I'm using on gold, is the initial trades based off the 5 minute, and then the stack trades are based off the 1 minute range. And if we just have a look at how it displays that on the chart, so we've got a thickish red and blue line where it's calculating the top and bottom of the 5 minute range. We're on a 5 minute chart here at the moment. Let me find a good opportunity to it'll look better if I do it this way. I'll drop it down to the 1 minute range. That way we'll be able to see it properly. Alrighty. So we've got the top of the 5 minute range. It's obviously working off this peak. And we've got the bottom of the 5 minute range, which is obviously picking this peak. Okay, so that's the top and bottom of the 5 minute range. But these finer lines, the finer red and finer blue line, that is the top and bottom of the 1 minute range. So we're on the 1 minute chart now. So we can see why that's the bottom and top of the most recent 1 minute range. That makes sense. And as most of the time it will look, the actual higher range time frame will have a much bigger distance between the top and the bottom of the range. So it's going to need to break above the red line to do the initial trade. But then after that, it only has to break above the smaller red line in order to stack the trades. That should make sense, I think. Anyway, guys, that is all of the settings. Just so I'm still playing around with what time frames work best and everything, which there are several people doing and sharing results on. On my US 30 Open though, I still just use 1 minute for both, and that's simply because when we trade the US 30 Open, we're trading. Generally I'm using a 10 minutes. So 10 minutes after the US 30 opens, it starts looking for trades, and because it's after a volatile event, which the US 30 Open is, you tend to get a lot more volatility and movement initially after the Open, and therefore I don't want to wait for a 5 minute range to form. I want to trade the 1 minute range so that it can get into the trades nice and quick and take advantage of the volatility that follows after. But yeah, we'll work out settings to suit others. I've been using the 5 minute for the initial and 1 minute for stack for my gold trades though. But anyway, that's all the settings at the moment, guys. As I said, the next video will be after I release a new update. Cheers for listening. Talk to you again soon. Obviously, sing out if any of those settings confuse you at all. Sing out so that I can clarify exactly what they do so that you understand. Have a good day.